What's going on, guys? Bexio back, and today we're going to be talking about investing and the steps to go forward with it to minimize risk and maximize reward. These are going to be steps that I took myself to grow the portfolio I have and how you can do it. And it's super easy. Just kind of go down the right steps and you build the foundation first of your savings and go into investing. So there's a lot of people debating savings versus investing. I think that they go kind of hand in hand. Saving is the first step to investing because when you're investing, obviously you have your money working for you, and when you're getting started, that could mean that you take on losses early. So you could go down a few percent. Maybe you get bad timing and you go down double-digit percents. And that's why I think building an emergency fund is the first thing that everyone should do. You should always make sure you have 6 months of expenses saved up just in case something should happen. We've seen everyone kind of have to look at that and have to make decisions. And if they had emergency funds, the people that had those were fine, and the ones who didn't really had to scramble. So we've seen like the last year and stuff. So 6 to 8 months is usually that standard range of an emergency fund. And once you have that, then I would go start investing. But you can even go more conservative and go like 12 months. That's like super conservative. But what you can do also from this, if you save up 8 months worth of expenses and you start investing, you can now pull from that, pull down to like 6 months if you want, and use that money to kind of invest as well over time as you grow your portfolio and stuff. But the first step, emergency fund, 6 to 8 months at least of funds, expenses, and then go from there. That'll build your foundation. So the reason you want to do that is because you don't want to have to sell your investments at a loss. So even looking at my portfolio, if you started at somewhere around here, like early February, you see it's just been a decline. And I haven't put any money into the stock market recently, but it's been a decline. So you don't want to get caught in a situation where you don't have an emergency fund and you end up needing some money. I mean, that was what, February till now is been over 4 months so far. So within that 4-month time frame, if something came up and you needed money, you would have been forced to sell at a loss, and you would have locked in those losses. And obviously no one wants to do that. So that's why you build that emergency fund first, and then you go into investing, so you don't have to sell at a loss, especially when you're starting. You don't want to have to get caught up in something where you need to sell at a loss. So the next step would be to build up the foundation of your portfolio. So I would start, the way I started was building up an index fund first. So I just put a lump sum of money into VTI to build that base, and VTI is obviously not very volatile. It's 3,000 companies. It's an insanely popular index, Vanguard Total Stock Market Index, and it performs very well. So it's something that a lot of people have money in, and a lot of people, it just kind of mirrors the market. And that's what you want. You want like a broad overview of the market as a foundation to build on. So when you're building more volatile assets, which I would go from indexes, VTI, VOO even. They're both very similar, so you pick one or the other. A lot of people pick VTI, I did. And then you can move on to blue chip stocks, things that are mega cap companies, you know, the Apples, Amazons, Microsofts, those companies that are so big, that have been around for so long and have proven themselves that you don't have to worry about. And they're more volatile than an index fund, but they're not as volatile as a small cap stock or something that hasn't really proven itself yet and is more of a speculation. And then obviously the reason I did that was because I wanted to get more exposure into the companies I like. So things like Apple, Microsoft, Disney, were the giant company. I mean, Disney's not really giant, but those are the big blue chip companies that I got into after dumping money into VTI. And I mean, I had great timing, but we see the past 3 months has been a great time to stack money into your portfolio and make something where you can reap the benefits later on in the year. I think that we're going to see kind of a tougher period that we've seen might be coming to an end, maybe another month or two of kind of tough scenes, tough scenarios where, you know, it's not, the market's not going to be going up like it was before, but it's not going to be going down as hard as it was before either. So I think this is a great period to be stacking money in stocks, plowing money in. If you have high conviction stocks, go into those. If not, you can plow into VTI, VOO, or just the blue chip stocks like Apple, Microsoft, the big name tech companies that have been hit really hard recently. And I think they're going to bounce great like near the end of the year. And then after you've built the foundation of like VTI, VOO, and index fund, kind of went out into a more riskier asset pool with blue chip stocks, mega cap companies, then you can go out into these extreme risk. It's not, I don't even go to like extreme risk type stuff, but I do have a speculative investment in like Plug, which everything I run through, I think Plug is a massive chance to be like an energy giant by the end of the decade. So this is like a long play. But that's after you build foundation of VTI and more like extra foundation, but slightly more risky blue chips. You can go into medium cap, small cap companies, and kind of just make sure they don't outweigh your other companies. So I got to a point where Plug outweighed like Apple and VTI, and it made up a lot of my portfolio. And Plug's recent sell-off kind of gave control back to Apple and VTI, which I enjoy more in stocks like stability, not huge swings up and down, kind of just constant growth is what I like to see more. So, but Plug is a large allocation in my portfolio that I have high conviction, and I don't see Plug like collapsing. I think they're going to be an energy giant, so they have a lot of growth to do. But that's like the tiers you would go through. Obviously, like I said, foundation, extra foundation, and then kind of more speculative stuff. Things that are mid-cap that maybe not everyone knows about, not super high-tier names, or maybe things that are just starting to get hyped up, like things like Palantir or Coinbase, or, I mean, I have like a list here on like potential buys that I have. Just things that I've seen YouTubers talk about and social media. And when you see a bunch of people talking about stocks, it's worth kind of giving them a look. Definitely not investing money based only on what social media people say. But after you get to this stage, it's probably going to take a year and a half to get to where it would be smart to start investing in small cap, medium cap stocks. Just because I wouldn't want to give so much control over your portfolio or mine to a speculative, longer term asset or stock where it can control your portfolio, and they're going to have massive dips. Like Plug had a 50% fall down, which for the rest of my holdings, I mean, I lost like 22% in 3 months because of Plug falling. Otherwise, it would have been like relatively even for the 3 months. So you just got to be wary of that and willing to take those dips and add to your positions and make sure you're getting companies that you have high conviction in. Just to recap, to take it all in, the first step would be build an emergency fund. Make sure that you don't have to pull from investments and sell at losses to cover something that might come up. Then building foundations with ETFs, VTI, VOO are the most popular ones, and they add great stability to your portfolio in the beginning. And then extra foundation with mega cap companies and blue chip stocks, things that have been around for a long time, where they're not going to shock anyone by making a ton of money or losing a ton of money. They're just going to kind of do their thing and grow. And then going into more speculative, medium cap, small cap companies. So hope you guys enjoyed this video talking about investments, how to get started. This is the way I did it and the way that I think minimizes risk and maximizes reward. So not to say you're going to make the most amount of money, but it's going to protect you from losing a lot of money, which is the most important part in starting a portfolio, I think. So let me know what you guys think. Let me know what your strategy are and any stocks that you think are on the up and up that you're hyped about. And as always, guys, don't forget to smash that like button and subscribe. We're on the road to 1,000 subscribers. See you guys in my next video.